Hey everyone, welcome back to Corporate Decoder, the place where we untangle the confusing world of corporate finance. Get ready, because today we're diving into a report that is all about money moving around, with some important changes to how this company handles its loans and pays its shareholders. Before we dive in, if you like getting straight answers from these official documents without all the jargon, make sure you're subscribed. And for those who want to chat more and get exclusive insights, join our Discord community linked in the description below. Today we're looking at a filing from Audax Private Credit Fund, LLC, and it's packed with news about their financing and how they're sharing profits. It's not a typical quarterly report, but more of a sudden update on some significant financial arrangements. So why an 8K filing, which usually means something urgent happened? Well, for Audax Private Credit Fund, LLC, the earliest key event we're looking at happened on the 29th of September last year. This is a report filed on the 3rd of October, so it's a bit of a look back at important changes that occurred late last year. Even though the report is filed this year, it's a bit of a time warp, but the details are crucial for understanding their financial operations. First off, who are we talking about here? Audax Private Credit Fund, LLC, or the fund as they call it, is the main player. They've got a subsidiary, APCFSPVI, LLC, which is actually the borrower in this situation. Think of the fund as the parent company and APCFFPVI as a specific entity set up to handle certain borrowing activities. Now, the big news is an amendment to a loan agreement. Specifically, on the 30th of September 2025, they made some significant changes to their loan and servicing agreement. This wasn't a new loan, but rather a modification to an existing one from October 2024. The key parties involved are the borrower, APACFSPVI LLC, the fund itself as the equity holder, Audax Management Company as the collateral manager, and big names like Wells Fargo Bank as the administrative agent and swingline lender, and Computershare Trust Company as the collateral custodian and agent. Essentially, they're adjusting the terms of a large credit facility. So, what exactly changed? The most impactful change is a significant boost to their borrowing power. The credit facility, which is like a pre-approved line of credit these companies can draw from, has been increased. It went from $500 million up to a much larger $600 million. This $100 million increase means they have more funds available to deploy, which usually indicates confidence from the lenders and a strategic decision by the company to expand its operations or investments. These aren't just about having more money, but also about having more time. The maturity period, which is when the entire loan needs to be paid back, has been pushed out by about a year. It was originally set to mature in October 2029, and now it's extended to the 30th of September 2030. Similarly, the reinvestment period, which is the time the borrower can use the funds to make new investments or loans, has also been extended by roughly a year, moving from October 2027 to the 29th of September 2028. This extension is a positive sign. It suggests that the fund anticipates needing these funds for a longer duration to execute its investment strategy. It gives them more flexibility and breathing room. They also managed to get a better deal on the interest rate. The facility margin, which is a key component of the interest they pay on borrowings before any default occurs, has been reduced. It dropped from 2.15% per annum to 2.00% per annum. This is a reduction of 0.15%, which might sound small, but on a facility of this size, it translates into significant savings over time. It shows that the company has likely improved its creditworthiness or negotiated better terms due to its performance or market conditions. Now, something interesting to note about Audax Private Credit Fund, LLC, is that it is identified as an emerging growth company. This means it is a company with less than a certain amount of revenue and hasn't been public for too long. This classification can sometimes allow companies to take advantage of certain relaxed reporting or regulatory requirements, although they have opted out of the extended transition period for new or revised financial accounting standards. This means they're keeping pace with the latest accounting rules, which is good for transparency. Beyond the loan agreement, there is another important piece of news about how the fund is returning capital to its investors. On the 29th of September, their board decided to declare a distribution of $0.38 per S-share. This distribution is set to be paid out on the 14th of October to shareholders who were on record as of the 30th of September. Importantly, these distributions can be received as cash or reinvested back into the fund's common shares for those investors participating in the distribution reinvestment plan. This shows the fund is actively returning profits to its owners, which is a positive sign of its financial health and commitment to shareholder value. Looking at all this, what is the bigger picture? the increase in the credit facility to $600 million, the extension of the maturity and reinvestment periods, and the reduction in the facility margin all point towards a company that is being strategically managed. They are strengthening their financial foundation, securing more capital, and extending their operational runway. This suggests they are confident in their future ability to generate returns and manage their debt obligations. The distribution to shareholders further reinforces this image of a healthy returning value to investors' entity. However, we should always look for potential risks. The report mentions that borrowings are subject to covenants and leverage restrictions under the Investment Company Act of 1940. This essentially means there are rules and limits on how much debt they can take on and how they can operate. While these are standard for such funds, any future tightening of these regulations or breaches of covenants could pose a risk. Also, relying on this borrowed money means their success is tied to their ability to deploy it effectively and generate returns that exceed the cost of borrowing. In conclusion, Audax Private Credit Fund, LLC appears to be strategically positioning itself for continued growth and operation. The amendments to their loan agreement demonstrate a proactive approach to managing their financial resources, and the declared distribution reflects a commitment to their investors. While the company operates within regulatory frameworks, the reported actions suggest a positive and stable outlook for now. Alright, that is our breakdown of Audax Private Credit Fund LLC's recent filing. What is your take on these financial moves and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and be sure to subscribe for more deep dives into the corporate world. Don't forget to check out the Discord link in the description for more great discussions and insights. Thanks for watching, and I'll see you next time on Corporate Decoder.